Have you ever just stopped and wondered why some of the smartest, most successful people you know, we're talking doctors, engineers, entrepreneurs, so often crash and burn when they try to invest their own money? It's a fascinating paradox, right? But here's the thing. It has almost nothing to do with intelligence. It's really a diagnosis of human nature and the crazy financial world we've all been thrown into.
So, let's just get right into it. Why does this happen? Well, the problem isn't that smart people don't know enough. In fact, it's the opposite. The problem is they think their success in one area, say building a business, automatically makes them a genius in the markets. But you know what? The market has a funny way of humbling absolutely everyone.
And this isn't just some abstract idea. I mean, listen to this story. At an investment conference in Miami, a guy, a really successful auto shop owner, told a reporter how he lost everything. He was doing all the right things, reading the news, staying informed, but then he followed a hot tip from some pundit on TV. And just like that, his life savings, gone. The real cost of bad advice isn't just the money. It's the time you can't get back, the trust, the self-respect. It's brutal.
Okay, so here's our game plan for this explainer. We're going to go on a little diagnostic journey together. First up, we'll pinpoint the external enemy, that constant storm of bad ideas coming at us. Then we're going to look in the mirror and see how we sabotage ourselves. And finally, don't worry, we'll get to the cure, the simple, quiet path to actually getting this right.
Right, let's start with all the noise out there. See, most investing failures don't happen because someone isn't brilliant. They start because of a misplaced belief in someone else's bad idea. You're not unqualified to do this. You might just be listening to all the wrong people.
Let's be really honest about the financial media's job. Is it to make you wealthy? No, its job is to keep you watching, to keep you engaged. What it's really delivering is a shot of dopamine wrapped up in a bold font. It's entertainment, not analysis. But here's the catch. Real investing isn't entertainment. It's slow, it's methodical, and frankly, it's supposed to be kind of boring.
And here's that disconnect in action. A headline screams market crash and everyone panics. But the reality? Oh, it was just a minor, totally normal 3% dip after 9 straight months of gains. These headlines aren't information. They are weapons of mass distraction designed to make you react. Because if you don't react, well, they lose you as a viewer.
So, who are these storytellers? You know them. They're TV pundits, social media influencers, random people on forums. They're all super confident, they're popular, and you know what? Their predictions are often spectacularly wrong. The market doesn't care one bit about your confidence or how many followers you have. It only cares about reality. And the reality is, most of this stuff is just noise designed to get you to do something. Because every time you buy or sell, someone else is making a little bit of money.
So here's the crucial takeaway from all this. If the piece of investment advice makes your heart race, makes you feel euphoric, or gives you a massive case of FOMO, be suspicious. Very suspicious. Good advice, real advice, rarely shouts. It kind of whispers with reason. It doesn't trigger your emotions. It engages your brain.
All right, now that we've diagnosed all that external noise, let's turn to an even more dangerous enemy, ourselves. The numbers themselves don't lie, but boy, can they be used to fool us. And the scariest part? We're often willing participants in our own deception. Let's start with some cold, hard, brutal math. Just imagine your portfolio drops by 50%. I know, it's painful to even think about, but it's not some crazy, unimaginable scenario, especially for people who take big, concentrated risks.
So, you're down 50%. What does it take to get back to where you started? You might think, oh, a 50% gain. Wrong. You need a 100% gain. A full double just to break even. The math is just unforgiving. It proves why the first rule of investing isn't make a ton of money, it's don't lose money in the first place. And we are getting manipulated by numbers all the time. We fall for survivorship bias. We only hear about the one fund that shot for the moon, not the graveyard of thousands that failed. We suffer from what's called denominator blindness, panicking over a 300-point drop without even thinking about how big the overall market is. And we get totally tricked by framing, where a fantastic one-year return is used to hide 5 years of terrible performance.
But look, this isn't just about math, it's about behavior. And I don't think there's a better or more tragic case study than the Belfer family. These guys were the American dream personified. They built a billion-dollar fortune from scratch, and then they lost almost all of it.
So how did it happen? Well, they made 3 classic mistakes that anyone, and I mean anyone, can make. First, they put every single egg in one basket.
Second, they place their absolute unquestioning faith in one company, which happened to be Enron, one of the biggest frauds in history. And, maybe most importantly, they truly believe their wealth made them invincible. They confused being rich with being smart.
And that's the core issue, isn't it? Our brains, as amazing as they are just not wired for modern investing. We're wired to run away from lions, not to calmly sit there and watch our portfolio drop 20%. And this wiring leads to arrogance, overconfidence, and that dangerous belief that this time is different. But the market is the ultimate ego crusher. So, we've diagnosed the external noise, and we've looked at our own internal flaws. So what in the world is the cure? Well, it's surprisingly simple. And yeah, it's a little bit boring, but you know what? It actually works.
Let's just completely reframe the goal here. Success in investing is not about making a handful of brilliant, genius moves. It is about consistently not making dumb ones. Like Warren Buffett always says, you don't need to be a rocket scientist. You just have to avoid the big, obvious, controllable errors.
So what does this wonderfully boring plan look like? It all starts with a simple, written plan. Know your goals. From there, you stop trying to be a hero picking winning stocks and you just own the whole market through low-cost index funds. Then you focus only on the things you can actually control, like fees and taxes, and you automate everything so your emotions can't screw it up. And the final, most crucial step? Go live your life. Seriously, stop watching the market every single day. Because this right here reveals our true advantages. Your greatest superpower as an investor isn't your IQ or some magical ability to predict the future. It's time. Time, combined with the discipline to stick with your plan, is so much more powerful than any attempt to time the market. In investing, patience isn't just a virtue. It's pretty much the entire strategy. So let's end with this thought. The market is absolutely a test of intelligence, there's no doubt about it. But it's not testing your IQ. It's not testing your ability to dissect a balance sheet. No, it's testing your emotional intelligence. It's a test of your humility and your discipline. So the question you really have to ask yourself is, are you studying for the right exam?